Tamikaze here with a video on quadruple witching, sometimes called quad witching, and what you need to know and what you need to know to trade on the day, or better yet, not trade on the day. So I just want to jump right into it. This should hopefully be a shorter video. I'm going to go through what I have written here, and I'm going to show you some examples and some things that have happened. So what is quadruple witching, aka quad witching? This refers to the third Friday of every March, June, September, and December. And on these days, 4 different types of derivatives expire on the same day: market index futures, options futures, stock futures, and stock options, monthlies specifically. Now, this usually results in increased volatility, and I'm going to go into that why. So how does quadruple witching work? Although futures and options generally expire on the third Friday every month, quadruple witching only occurs 4 times a year. On quadruple witching days, especially during quadruple witching hours, aka the last hour of the day, it's common for traders to try and unwind their futures and options contracts before they expire. That way they're not stuck with any potential problems after hours. So they want to make sure they lock in their profits or at least minimize their losses. This often includes repurchasing contracts and closing out market positions. So why is this important? Quadruple witching days are usually very volatile. You see ups and downs as well as large trading volume, and you can anticipate the potential effects of these relatively turbulent trading days. So I just have a few things I want to note. Quadruple witching is a purely gamma-based day. And what is gamma? Gamma is basically the calls and puts that affect the market. People that sell the calls and puts, sometimes we call them market makers, are going to try to make as much money as possible. So if there's a large call volume or large put volume, they may try to make the calls expire out of the money or the puts expire out of the money, what we call max pain. So at max pain, both calls and puts are expiring out of the money so that the market makers make the most money. So if you see a stock that is close to their max pain level, it's likely that they might try to pin it at that max pain all day. If you see something that is far on one side or the other, you may see a lot of volatility, ups and downs, etc. So you could expect wild swings based on gamma and how options. So looking at the open orders or OI, open interest, on a stock is very important on this day. How many contracts are expiring that day? Where are they expiring? And is it close to those prices now? Because if it's close, they're going to try to drag it to the price where the market makers make the most money. Usually this happens in the last 15 to 30 minutes of the day, with the last 5 to 10 minutes seeing rapid movement with people finalizing their positions. So I just want to go through a couple of days in the S&P 500 on the ETF SPY. We're going to look at a couple of the past days in the last 3 years, specifically the last year in general, because that's going to have the most likely scenario. So I'm just going to delete this. We're going to get right into it. So I have up here the last 3 years of the S&P 500 marked out here, and you can see kind of generally what happens. So you can see generally we have a red day or a minorly green day, and usually you'll see big wicks with smaller bodies. This is back in 18 when the market was a little bit more stabilized, and you can see a lot of red dojis forming here, or just small green dojis and green dojis in particular. Now the ex-dividend date and the COVID crash was huge. We saw some of the biggest swings as well I've ever seen in the market, but ever since then, it's been a little bit more stabilized. Red, red, green, but huge swings both ways. So you can see this had large call volume here. So on this, the calls, they pushed it down at the end of the day to expire all those out of the money. And then again, doji, doji, not a lot of movement, but big swings. And we have a doji going into tomorrow. And so it's going to be interesting to see what happens. Now, what I'd like to tell you is 67% of all S&P 500 options are puts right now, as well as most of the calls being the 450s. So I entirely expect tomorrow to be pinned under 450 and above 440. So we might see some wild swings between 440 and 450, as most of the puts are around 440 and most of the calls are around 450. So we may go up to 450, down to 440, etc. I don't expect it to be that wide of a range. I actually expect it to be an inside day tomorrow, but lots of movement, ups and downs throughout the day. So just make sure you're playing safe tomorrow. 0-day contracts are going to be extremely volatile, and I wouldn't play them. I wouldn't play tomorrow at all if you're inexperienced. Now, if you like volatility and you like playing between pivot and reversal points, tomorrow is a great day to scalp. But in general, like I said, if you're inexperienced, tomorrow's a day to go get your popcorn, go play with your kids, just go do something not in the stock market. So I hope this helped you understand why uh, quad witching is referred to as such a unique day. It's not necessarily anything special other than that's when most contracts expire. So people are going to try to manipulate to make the most money based on getting those contracts to expire out of the money. And that's generally what you need to take out of this video. So I hope this helped. I hope you have a great night, a great day tomorrow, and let's make some money.